Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and it's a spectacularly exciting day and week ahead of us because lo and behold, no, Senator McCarthy and President Biden could not come to a resolution of the debt ceiling crisis. Now, they're saying we're going to continue talking. It was a positive meeting. Progress was made. And yet they remain absolutely at opposite ends of a very wide spectrum on how to solve this crisis. And neither side is showing any signs of moving. And then even if they get an agreement, they have to get the hardliners within their own respective sides of politics to vote for it in the Congress. So this is a long way from being done. We could be in this state of ongoing talks, or even then there's an agreement, but then it's being tossed about in Congress by various hardliners on both sides, and we have a debt default. So the first actual official US debt default will occur on about the 6th of June. Janet Yellen has come out and said they'll start running out of money on the 1st of June. I previously said around the 8th of June is when they'll really start winding back federal government services within the country, and it will just get worse day after day after that. In 2011, the stock market corrected 15%. Because everyone thought there could be a US default, there wasn't. This time round, the stock market hasn't corrected at all, and everyone's expecting a resolution. So, if history repeats itself, the market could well get this wrong too, and the US is going to have a spiraling crisis that gets beyond the control of anyone. These things do happen. It's kind of what happened in 1929. The stock market should have been edging up yesterday on the idea that there's going to be a positive outcome from the Biden-McCarthy talk, but it wasn't. It was heavy. It was up. It was sort of tossing around, but it didn't have that upward lift it should have. Of course, we had several federal presidents of the Federal Reserve saying that they expect interest rates will continue to go up. And even if there is a momentary pause, we would be wanting to make it clear to people that there's still a tightening bias. And this is what I've been saying all along. So we forecast the Fed interest rate cycle better than Goldman Sachs, better than Citibank, better than just about anyone in the world. From way back, we said it would go far higher, for far longer, and there would be no rate cuts this year, which went in the absolute face of all the market sentiment and commentary and other economists out there at the time. But this is how it is unfolding. And that is because you need to understand that inflation is not a short-term aberration. You need to understand that interest rates being near zero were the aberration, and that interest rates being up at these levels or higher is actually normal. It's just that it hasn't been normal for so long, people forgot what normal is. So interest rates are going to be higher for longer. Manufacturing's in recession. The housing construction industry is going into recession. Property prices are falling. This is all the US. Property prices are falling. Stock market's still well off its previous highs. So it's still down. And bond markets are falling. And all of those falling markets are going to fall much more sharply if the scenario I just painted out at the start of this video actually does begin to unfold. This is, yes, a nightmare scenario. And guess what? It seems to be panning out. Now, I think the best possible outcome now will be we're virtually at June 1, June 2, June 3, June 4, before something gets passed to lift the debt ceiling. We could see a US default, but then they solve the ongoing, basically providing money to the government problem. So government keeps going. But it is looking like there is going to be a moment that could break the back of the US dollar. At first, the US dollar could be strong out of just global panic because bond markets all around the world will be severely impacted and quite quickly so. And so there could even be a bizarre US dollar rally in the midst of the end of the US empire scenario. So the US just needs to be repriced back into the pack. it's been priced, its equities and its dollar and its bonds have been priced as some sort of standout feature on the global financial scene, which the United States was for decades, but it hasn't been for the past decade or two, but it's maintained that pricing. And I think that pricing is about to be readjusted much lower. So, and the other problem with the equity market at the moment is it looks like even a positive outcome is already fully priced. So a negative outcome could have dire consequences over the short, near and medium term, if not long term, for the US equity market, the US dollar and bond prices. Yields are going higher. So that will be a consistent weight on top of a declining economic outlook, which could intensify, obviously, on this crisis becoming worse than it already is. Thank you very, very much for listening. I hope you have a great day. Clifford Bennett, Chief Economist, ACY Securities. Cheers.